everyone. Welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of Chapter 7 from the book The Only Cryptocurrency Investing Book You Need by Freeman Publications. It has been created with the help of AI. The chapter is titled 2 Ways to Not Get Exposure to Crypto in the Stock Market, plus 1 Way We're Reconsidering. You can read the original post at samfury.com.
Hey everyone, welcome back. Ready for another deep dive.
Always ready. What are we getting into today?
Today we're talking all things crypto, but not just the basics.
Oh.
Yeah, we're going beyond just what crypto is. We're diving into how to actually navigate the, kind of crazy world of the stock market when it comes to crypto.
Sounds intense.
It is. And to guide us, we're turning to a great resource.
Let's hear it.
Chapter 7 of The Only Cryptocurrency Investing Book You Need.
Ah, that's a classic.
It really is. And I think it's perfect for this deep dive because, well, I'm sure a lot of our listeners are in the same boat as me. They're fascinated by crypto, all the possibilities, but also kind of intimidated by how wild the market can be.
Oh, absolutely. Crypto definitely has a reputation for being volatile.
Right. And this chapter really digs into that. It doesn't just talk about, the financial side of things, but also the emotional impact of all those ups and downs.
Yeah, it emphasizes how important that emotional resilience is if you're going to, weather the crypto storms.
Which is, well, exactly what we're all about here. Learning how to be smart, informed investors.
So before we get into the specifics, just to set the stage, can you remind us why crypto is so much more volatile than traditional stocks?
Sure. I mean, in simple terms, crypto is still like the new kid on the block, right?
New kid on the blockchain, maybe.
Exactly. It hasn't been around as long as the stock market. It's not as integrated into the global financial systems, which can make it a little bit more susceptible to speculation, quick shifts in sentiment.
Okay, so it's kind of like
A speedboat versus a cruise ship.
Ooh, I like that.
Yeah. The speedboat is exciting, nimble, but it can also get thrown around a lot more easily in rough seas. And crypto, that's kind of like that speedboat, right? Zooming around, exciting, but also, prone to some pretty big swings.
Okay, yeah, that makes sense. And I imagine for someone new to investing, those swings could be, well, pretty scary. Oh, absolutely. And the chapter really gets into the emotional side of things. It's easy to get swept up in the hype when prices are going up, but then panic when things take a dip.
Oh, yeah, that fear of missing out. FOMO.
Exactly. But that's where, having a solid strategy comes in, setting realistic expectations, not letting your emotions control your decisions. It's all crucial to success with crypto.
So knowing all that, it's no wonder people are looking for safer options.
Yeah.
Ways to get involved in crypto, but maybe without quite so much of that roller coaster ride.
Right. And that's where things get interesting. This chapter actually it debunks some common misconceptions about supposedly safe ways to get crypto exposure in the stock market.
Oh, interesting. So investments that sound good on the surface, but then maybe have some hidden risks.
Exactly.
Okay, so let's break down some of these crypto traps, shall we?
Let's do it.
Okay, first up, we've got the ProShares Bitcoin strategy.
When that first launched, it was a really big deal. First U.S.-based Bitcoin ETF.
Right. I remember thinking, okay, finally, a way to get into Bitcoin without all the stress. But it turns out it's not that simple.
Not quite. You see, the thing is, it doesn't actually invest directly in Bitcoin.
It doesn't.
Nope. It invests in Bitcoin futures contracts.
Yeah.
And it uses this kind of complicated mechanism called rolling yield.
Okay, hold on. I think we need to break that down a bit. So what exactly are futures contracts and what is this rolling yield business?
Okay, so imagine you're a farmer, right? You're worried about the price of corn dropping before you can harvest your crop.
Okay, going with the farming analogy. I like it.
So you enter into a futures contract with a buyer. You agree on a price for your corn, right? And on a specific date in the future, they'll buy it from you at that price. This protects you, the farmer, from any price drops.
Okay, so it's like locking in a price ahead of time.
Exactly. And it's essentially doing this, but with Bitcoin. Instead of buying Bitcoin directly, they're making these bets on what the price will be in the future.
Ah, I see. And the rolling yield part.
Right. So those futures contracts, they have expiration dates. So to keep their exposure to Bitcoin, Beto has to constantly sell expiring contracts and buy new ones further out in the future.
Ah, and that can get messy.
Yeah, it adds a layer of complexity and cost, and it makes the ETF a lot more, unpredictable and potentially even open to manipulation compared to a traditional ETF that just holds the asset directly. It's not as straightforward as just buying and holding Bitcoin.
Got it. Okay, so we've talked about ETFs. Let's move on to index funds. These are, often seen as the gold standard for passive investing, but you're saying they can have their downsides in the crypto world too. Okay, example number 2. The chapter talks about the Bitwise 10 crypto index fund. Now, they market themselves as the S&P 500 of crypto, which, sounds pretty appealing. Everyone knows the S&P 500. It's like, a household name.
Right, so they're definitely playing on that familiarity, trying to evoke a sense of trust and stability. But
Okay.
the reality is, well, there are some catches.
Lay it on me.
Okay, so first off, their expense ratio is pretty high, like 2.5%.
Well, 2.5%. That's a lot higher than most traditional index funds.
Exactly, and that eats into your returns right off the bat.
Ouch. Anything else?
Yeah, so unlike the stock market, which is pretty much a Monday to Friday thing, crypto trades 24/7.
Yeah, it never sleeps.
Right. But this Bitwise fund, it only trades on weekdays, which means you're missing out on all the price action that happens over the weekend. And with crypto's volatility, those weekend swings can be huge.
Okay, so it's like trying to surf, but only paddling out on weekdays.
Exactly. You're going to miss some serious waves. And that means this fund is likely to underperform compared to the actual crypto market.
Right. So not quite the set it and forget it simplicity that people associate with index funds.
Not in this case.
Okay, last example. Let's talk about the Grayscale Bitcoin Trust.
Right.
Now, this one was promoted as a way to get crypto exposure within your retirement accounts, like your 401k. And for people thinking about long-term growth, saving for retirement, it sounded pretty tempting.
Oh, for sure. Who wouldn't want a piece of the crypto pie in their retirement portfolio? But
There's always a but.
well, there are some things to consider here. First, the management fees, they are higher than you'd see with a typical index fund. Though, to be fair, they have been coming down.
It's good. But what else?
This is the big one. You're not actually buying Bitcoin directly. You're buying shares of this trust that holds Bitcoin.
Okay, so what's the issue with that?
Well, sometimes the price of those shares, it can be lower than the actual market value of the Bitcoin they represent. Doesn't make much sense.
Not at all. So even though it's marketed as this safe, stable option for retirement accounts, you could actually be hurting your returns in the long run.
You got it. And all of this just goes to show how crucial it is to do your research in the crypto world. Don't just buy into the hype. Sometimes the best approach, even though it might feel scarier, is to own Bitcoin directly.
So you have more control, you understand what you're investing in, and you can avoid those hidden fees and complexities.
Exactly.
Great reminder that simpler is often better, but you got to do your homework first.
Absolutely.
So as we wrap up this deep dive, I want to leave our listeners with a question. If even these well-established funds, these, seemingly safe bets, have these kinds of drawbacks, what other hidden risks might be out there in the crypto world? What questions should you be asking before you, invest your hard-earned money?
That's the key, isn't it? Asking the right questions. Because knowledge, especially when it comes to something as complex as crypto, is power.
Couldn't agree more. Thanks for joining us for this deep dive, everyone. And remember, always do your research, stay informed, and invest wisely.
See you next time.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries, which you can download as PDFs, as well as other exclusive content. It's all completely free at samfury.com.